So here's an RBI for you. According to Carson Group, if the S&P 500 pops more than 1% today, it'll be the first time that we have begun the year with 3 straight days of 1% gains or more since 2003, a 22-year phenomenon. If it happens, Kelly.
It's looking a little harder now with the S&P only up 0.5%. And what is RBI?
Random but interesting.
I thought it was a baseball analogy.
Well, it is. I stole it from not only that, but also the Reserve Bank of India.
That's right. Them too.
They have they have at RBI or something on Twitter. Either way, while this may be random but interesting, does it actually matter to the markets and your money going forward? Or is it just a nice stat? Jack Ablin is founding partner and CIO of Cresset Capital. Jack, listen, we had a terrible end of the year. Everyone's like, well, the market's going to go down. We're going to lose January. Now we're going up. People say, well, the market goes up. We're going to win January. These are nice stats. They're a little fodder for TV. But do they actually matter to the overall direction of the market?
No, probably not. Week to week, even month to month is pretty much random. Although I will say, and really what I wanted to point out in my note was that the market right now is fixated on this period between Election Day and Inauguration Day. So everyone is focused on policy and the potential for policy to impact markets. What we find is that once Inauguration Day is over and we look out to the rest of the year, it's really back to business as usual. So perfect example, Trump's inner circle said they may be scaling back on some of the tariffs. Of course, we started to see the dollar decline, some other reaction to that. That type of intense scrutiny is pretty much dissipated after January 20th.
Yeah, what's going to be the most important thing then? After January 20th, we get through all this stuff. We look ahead in the calendar to May or June, Jack. What are we going to be talking about? What is going to be the next big thing for equities? Is it interest rates or tariffs? Is it something else?
I think it's interest rates, Brian. I mean, keep in mind that we were able to deliver 20% plus returns last year on, call it 9 or so percent earnings growth. So clearly multiples expanded, and high multiples need low interest rates. And interest rates, unfortunately, are going in the wrong direction. So in order for us to maintain these levels, we're going to need to see earnings go up, and they will for most of the S&P, but we're also going to need to see interest rates, whether they're the 10-year rate or the overnight rate, come down. And we just don't see too many prospects of that right now.
I agree with you, Jack. I mean, and I think a lot of the market's looking at 462. Maybe we can show the 30-year also and thinking, all right, we've kind of moved past the initial digestion phase, and we're supposed to kind of, maybe be consolidating this move, not continuing to see things kind of break out to the upside.
Yeah, I would tend to agree, but there is this, I would call it the January effect. Now, usually the January effect affects small cap stocks, not the mega caps. But we are seeing the rally, sort of we'll call it the Santa Claus rally on hold, has now pushed into January. But like I said, after January 20th, I think back to business as usual, and everyone's going to want to focus on rates. The remarkable thing about if we dial back to 2016, once the inauguration was over, after the Trump's first term, 1 year hence, what was the best performing equity market? China. China was absolutely hammered between Election Day and Inauguration Day, and yet it came back and delivered a 42% return. Now, I'm not suggesting necessarily China's going to rally that much. I do think that there could be a cyclical pop in China, but I think we have to look beyond the kind of the traditional cast of characters for moves for 2025.
Not many people are going to come on after the recent stretch of data and performance and say, Jack, look at China.